Welcome to the second session of this morning, which I will chair and is entitled the Pandemic Panel. Now, this session takes a special format. It is a panel, although it's not a regular panel where we're going to have sort of three presenters having some broad discussions. We're going to have three papers, or three academic papers presented. And the three papers are sort of related to the pandemic crisis we've been going through since last year. Now, the first two are specific about the COVID crisis. The first one will be about the effects on bank stock prices of COVID-19. The second one about the exit, in particular for emerging markets of the crisis. And the final paper, which is not specific about the COVID crisis, will talk about the role of corporate loan spreads to predict economic activity using data from the last crisis and also using current data, which maybe might help us think about the exit from the COVID crisis as well. Now, because we follow a different format, we don't have discussants for this session. So we're going to give a few more minutes to each presentation, about 20 minutes max for each presentation. And after each presentation, we'll have about 10 minutes of Q&A. So be ready with your questions by the time each of the paper finishes. And I'll manage that discussion for each of the three papers. Now, let's start with the paper, the first paper. So I'll pass the microphone and the video to Sascha Steffen, who's going to talk about the crash of bank stock prices during COVID-19. You have 20 minutes.
Perfect. So thank you so much for inviting that paper to this panel today. That is joint work with Acharya and Rob Engle, both at NYU. Let me say, if I'm a little bit slow, that it's because it's 4:30 in the morning here in Germany. But nonetheless, and I hope next time to be back in Singapore, because it's always not only a great conference, but always a great place to visit as well. So if we look at the motivation, I think always looking at these charts basically tells a large part of the story. The left-hand side, you see a panel, you see a figure, which is basically the cumulative drawdowns of US publicly listed firms in terms of credit lines that have happened last year since the beginning of March. And what you can see basically is that within a matter of a few weeks, we saw a drawdown volume of more than $300 billion in aggregate, and that only by publicly listed firms. Phil Strahan has a nice paper in the Review of Corporate Finance Studies in which he uses aggregate balance sheet data from the core reports, and across all public and private firms, the drawdown was basically more than 500 billion. What made this so special, also in terms of comparing that to the global financial crisis, is the intensity of drawdowns. Within 3 weeks, an amount of credit line has been drawn down that represents basically what has happened during the full year during the global financial crisis. And on the right-hand side, you can see what happens at the same time in the stock market. So what we plot here is the stock price development scaled, basically holding stock prices fixed at 1 the beginning of 2020. You can see how that developed, and you can see that for banks, which is a solid line, as well as for non-financial firms in the US, which is the dashed line. So you can see that bank stock priced on basically about 50% until March 23rd, 2020. And bank stock prices haven't really recovered that well until the end of June. That's the period that's shown here. But even if you would basically plot that until the end of the year, it took a very long time until bank stock prices actually really rose again. That only happened towards the end of the year, when the new sort of like the speed of vaccinations and so on has become much clearer, that the US recovery is back or the US economy is back on the path of recovery. What's important is that the stock price decline of non-financial firms was not that pronounced. And what we're trying to do in this paper is to link the stock price decline to the credit line drawdown and the liquidity insurance functions that banks have, that was basically put into overdrive in such a scenario of aggregate drawdown risk. So, as I said, more than $300 billion, particularly from the weaker firms, have been drawn down in a very, very short period of time. And what we actually ask ourselves is that what we call balance sheet liquidity risk of banks also priced in their stock return? And if so, how can we explain that? Is that because it's basically a solvent, is the capital issue, right? That stock market depreciates sort of the what can banks do in terms of new business opportunities provided the capital position that they have? Or is this because of liquidity, that this drawdown volume is basically a run on these off-balance sheet like commitments of banks? So what is it? And whether this is in terms of expected losses, or is this basically in terms of the capital that has been locked in for drawdowns through these commitments? This is what we try to find answers to. So what do we do? And I might be a little bit faster, so let me tell you everything that we do already. Here at this point, we show that the liquidity risk or balance sheet liquidity risk, I'm telling you in a second more what I mean by that explicitly, explains bank stock return episodically. And I mean episodically in specific periods, and that both in the cross-section as well as in the time series, which means that in crisis times, and particularly in aggregate, during times of aggregate risk, firms that have these prearranged credit lines start to draw down, and that then becomes a risk for banks, and that's basically reflected in bank stock return. And we show that this aggregate drawdown risk that has materialized in March last year is not captured in our traditional measures of risk. On the one hand, on bank exposures, I'm going to talk more about that. So what do they have in terms of, for example, loan exposures to the most affected sectors during the pandemic, such as the oil industry, the retail industry, or the hotel industry, for example. But it's also not reflected in what we think about as kind of tail risk measures, such as the systemic risk measures, for example, the S risk, which is the one that has been developed by Viral and Rob Engle after the global financial crisis last year. So what we do is we confirm that these kind of episodic pricing of risk in bank stock return is not only specific to the current pandemic, but it has also materialized during the global financial crisis. However, and that's where the key difference is that during the global financial crisis, the liquidity risk or the balance sheet risk of banks, which was determined by banks' exposure to wholesale funding, so through liquidity risk, basically, while during the COVID period, it can be explained through the unused credit lines that banks have off their balance sheets. We do find evidence that this is more consistent with a capital channel, so solvency issue, rather than a funding channel, which makes sense given the a large amount of liquidity that central banks, both in the US but also globally, have provided to these banks. And then what we do is we show more analytically that this episodic credit line drawdowns can be incorporated in a bank in the stress test, because the question is, if this drawdown risk affects banks, then the question is how should we deal with that? And one would be to actually increase capital requirement, because apparently regulation has not done that. And so one way to look at that is through a stress test. And what we do is we augment the S-risk framework to incorporate a conditional S-risk component, S-risk C, and that's sort of the amount of capital that's being required or should be required by regulators in order to account for the possible stock price decline of banks during such a time of aggregate drawdown risk. So that's what we do in the paper. I'm going to skip the data for the period of time, but it's basically all large banks above 100 million. And you can be sure that the banks that we include in terms of also credit line commitments capture roughly 90% of all credit lines in the economy. So how do we measure a bank balance sheet liquidity? We actually consider that in three parts. On the one hand, we look at the unused commitment that banks have off the balance sheet. We add wholesale funding. And then, of course, we take out what banks have in liquidity on their balance sheet. And given that these banks are also different in size, we scale all of that by total assets. So this is a bit more comprehensive. I'm going to talk much more about unused credit lines rather than wholesale funding. But if you were to look at also different episodes over time, then it could be that these different components might have actually different importance. And that's also why we should look at this a little bit more holistically and then kind of zoom down more in terms of the unused credit lines at specific points. So if we plot that and look at how does liquidity risk actually look like for banks? On the left-hand side, you can see that overall measure since 2010, and how that basically declines afterwards, and then it rises again, and then in 2020 it basically drops down. This is quarterly data from the bank, from the core reports, and that is probably likely driven by the credit line. So if we now split that up into unused credit lines and into wholesale funding and plot all of these components individually, we can see that the exposure of banks to unused credit lines has actually increased over time, while the exposure to wholesale funding has actually decreased, right? And that's I think one of the key learnings also, that regulators have dealt with banks after the global financial crisis, focusing on this liquidity risk of banks that has materialized then, but they have not really put into focus the capital issue that was associated with, for example, the credit lines that have been outstanding. And that's something which is sort of basically materializing during the pandemic. So it appears to be that these unused commitments are the key risk issues that banks are actually facing. So if you now look at sort of how did banks fare during the pandemic, which had low versus high liquidity risk, you see on the left-hand side that the stock price decline was substantially more pronounced by about 10 or more basis points for banks which have high relative to low liquidity risk. And on the right-hand side, just a correlation, a scatter plot. If we just plot bank stock return on the liquidity risk, you see a negative correlation. So those banks performed worse, which have high liquidity risk. And we do that also a bit more methodologically correct, so to speak. So our baseline regression basically regresses the excess returns of banks on the liquidity risk component measured as of the end of 2019, and then a bunch of control variables, because you have realized probably that it's important to control fully or as good as possible for the existing portfolio risk, sort of to tease out the individual component of the off-balance sheet commitments here. Our period is until March 23rd, 2020, because that was where most of the initial period was basically concentrated before the Fed interventions, and then we saw the stock market also returning as well. So what we see is if we start and add also more of these control variables that we have, we see that liquidity risk seems to be an important factor in understanding bank stock returns, and in terms of economic magnitude, about a 1 standard deviation increase in liquidity risk appears to reduce bank stock return by about 5%, and that's has to be interpreted relative to the unconditional mean return, which is about 7% in our sample period here. So what we do is we try to control for exposures on balance sheet as good as possible. We use core report data, but then also in column 3 and 4 here, we use actually deal scan to look at what is the actual still outstanding exposures that banks have through large syndicated loans in the oil sector or in other sectors such as retail, such as housing, games, and so on, that have been particularly affected. And you can see that those exposures have substantial negative impact on the stock return. And if we include S risk as a measure of downside risk of banks, so we see also that has a substantial negative impact, but the effect of liquidity risk still persists. So we do a lot of other tests to support support that, we look at different components. So we look at unused commitments, wholesale funding, and so on individually. And it appears to be that the unused commitment are the most important part in understanding the bank stock return. We look at the episodic nature more clearly by looking at different time periods. We look at the reversal. So what happens actually after the Fed has, and the Federal Reserve measures as well as fiscal measures have been implemented. And we observe this substantial reversal of bank stock prices for those banks that actually have suffered most from the undrawn credit lines. And then we look at and compare that to what has happened during the global financial crisis. And we see that in a way history does repeat itself because we see a similar effect also during the global financial crisis. But as I said, that was much more pronounced due to the wholesale funding exposures that banks have. So how can we understand that? And I would like to sort of like make clear that we think that this is rather a capital issue rather than a liquidity issue. So what we do in the first step, we try to disentangle these mechanisms by creating a new measure, which is gross or net drawdowns. So the gross drawdown is basically the percentage change in unused credit lines from 2004, from fourth quarter 2019 until the first quarter 2020. And the net drawdown is basically the change in these commitments minus the change in deposits. Because it appears to be that a large part of these credit lines have been redeposited into the banking system, alleviating the liquidity constraints. So if we're controlling for net drawdowns, so to speak, the gross drawdowns actually tell us what is the implication of the undrawn credit lines in terms of the capital having controlled sort of the impact on deposits. That's the idea of that test. And you can see that, and let me draw your attention to the right-hand figure here, where you can see the net drawdowns over time. You see that they actually decline a lot, which means that the relative to the undrawn, to the drawdowns, the redepositing, even more deposits have been put into banks. So that makes it even more clear that liquidity does not seem to be the binding constraint. So if we put all of that into a regression framework, we can see that controlling for gross drawdowns, controlling for net drawdowns, those banks which have more ex-ante exposure to undrawn credit lines and that have been drawn down in the first quarter have suffered substantially more in terms of stock price declines relative to other banks. And if we add also to the equation the banks that have a higher capital buffer before the pandemic starts, they actually perform better, which tells us that the bank capital actually matters, right? So those banks which had more capital buffers had actually lower realized stock return losses compared to other banks, right? And again, controlling for S risk again doesn't really change that. Huh? So, and then again, in economic magnitude, a one standard deviation increase in the gross drawdowns reduces bank stock returns by roughly 4.2%. What we do then also is to look, okay, what is the implications of that, right? So if banks actually suffer in terms of stock returns, in terms of from this credit line drawdowns, then that has to have implication for their future business activity. And we do look at that in terms of how actually is the loan supply of banks affected if they have higher liquidity risk. So this is what we do. We look at this in the quasi-Mian sense. So we look at this actually within syndicate and see that within syndicate which banks actually in the loan lending relationships drop out after the COVID pandemic started. And we can see that particularly term loans, so those loans which need to be funded, they have to, these term loans were substantially fewer or less of these have been issued for banks that have higher gross drawdowns. Yeah? So let me just basically, and then I conclude, I just want to show you what we do in terms of stress test. So as I said, apparently there's no mechanism that prevents that from happening. And apparently that has not been the focus of regulation so far. So if we want to do that, we need to kind of focus on the potential drawdown risk that banks face. So what we do is we augment the systemic risk framework and ask, okay, what is sort of an incremental systemic risk component that needs to be added? And that has to be basically what in expectation is the debt that accumulates during the crisis minus the pre-existing debt condition, meaning that what is the expected drawdown, what is the sort of the expected drawdown rate condition on a crisis times the ex-ante undrawn credit commitments. That's sort of the increase in balance sheet debt that is actually going to happen once these drawdowns kick in, times the capital constraints, so the capital requirements say that banks have. If we do calculate that and we measure the drawdown rate based on historical realized drawdowns during crisis, if we look at that, then we can estimate basically, that in the total banks that we have, the incremental capital that's missing in the system is roughly 250 billion for the banks at our sample. So that's quite substantial. So that's basically the capital requirement that banks should have put on banks to account for this aggregate drawdown risk during a crisis. And let me stop here. I think the overall message that we have is that off-balance sheet risk, undrawn credit lines do matter. And they matter particularly in times of an aggregate shock that we have seen, for example, last year. And what's happening is that there's a run on these credit lines, so to speak, which impacts the intermediation activity of banks because they don't have the capital to support that. And that's basically prevents them to earn performing intermediation function going forward. For example, in terms of providing a credit to the overall economy. And that apparently is something that we need in order to sort of bring the economies globally actually to a path of recovery. So let me conclude here, and I look forward to the discussion. Thank you very much.
Okay, thank you, Sascha. So we have a few minutes for questions. Yeah.
Sure.
Okay, well, may I start off? If nobody else wants to? Sure. So could you talk about regulatory forbearance and how much we can actually learn from banks' balance sheets right now? So I've been watching the Canadian authorities, and they basically kind of changed the rules a lot on what it takes to make a mortgage or a debt non-performing. And those will all have to unwind as we come out of COVID. And how much distortion would there be in bank balance sheets in general because of these sorts of things?
I think this is a great question. I think not only for the US but also in other economies. I think we see the same, or we ask the same question also in Europe and also in Germany. So I think that on the one hand, it is interesting that regulators appear to have realize that this kind of risk in terms of the credit lines that I've talked about, not to the extent that we would like, but also in the stress tests that have been designed by the US, these credit lines now play actually a bigger role. So I think that's a good sign overall. This, to my understanding, that has not happened in Europe. But we have not actually performed a similar test there. And it might actually be the case that the risks that banks in Europe face actually might be somewhat different compared to what US banks face, at least in terms of credit lines. But I think your question was more broadly in terms of what can we actually expect in COVID.
Or also, how much can we really trust the data right now?
Can you say this again? I didn't get that.
How much can we really trust the data? So when a bank says it has this many $1 million in performing loans, but the definition of performing loans has changed several times through the crisis, or they're being allowed to reclassify things, what does that do to research on bank balance sheets?
I think this does make a lot of sense. I mean, what we are struggling with also is the fact that not only maybe the definition of non-performing has changed, but also when do actually firms have to file for insolvency? Because in Germany, at least, that has been completely has stopped completely. And what's going to happen once firms actually have to do that? So which firms actually are going to file for insolvency, which actually should. I think the zombie lending issue here has also been an important part, not only in Europe, but also in the US then, in terms of what firms actually should not be there. And then we should be worried about, okay, what might be the implication on banks and bank balance sheet, but also what might be the implication on the other firms and the industries that these firms are actually operating in, right? Because we know from prior research that having these firms still operating has a huge impact on the performance of other firms, because it actually destroys competition, destroys rents, firms don't innovate, and we have actually growth implications also, right? So this could actually be the question, okay, what does this have, what is the implication on the growth path, and could this actually have also basically has a muted impact, or does it actually reduce the growth going forward? Right. And that would actually have, again, implication for banks. So there's a lot of actually moving parts that come together and play a role. And more precisely to your question, it is difficult to trust the balance sheet data, right? Because you don't know what these the non-performing loans, how is this understated? What should this actually look like once these other effects of firms should actually be incorporated? One possibility, of course, is always, and I mean, we've done this a lot in a European setting also, in terms of comparing banks, look at market data. Yeah? So if I present what I've just shown you in Europe and talk about, okay, is this something we should be concerned? Then actually the answer is, no, we should not, because European banks are actually much more resilient than US banks these days, because they have entered the crisis with stronger balance sheet. And I say, okay, look, that's not true at all, right? That might be true on paper, because the regulatory capital ratios might appear that, or might suggest that this is the still case. But if we look at market data, then the bank stock price, the market to book ratios of banks are actually substantially lower in Europe than they are in the US, which suggests to me at least that there's actually a lot of concern that there's much more risk on bank balance sheet that actually has, compared to what has surfaced yet. So I think
let's see if there are more questions, Sascha. Sorry to cut you off.
Sure.
I worry I'm monopolizing you. Thank you very much.
Yes. Let's see if there's more questions, please.
Can I ask a question? This is Takeo.
Yeah.
I think that this is very interesting paper. I'm trying to digest the result, and I guess what you find is this risk of undrawn credit line somehow shows up as insolvency risk rather than the usual liquidity risk we think of, and you contrast gross drawdown and the net drawdown. So you control for the change in the deposit. But I'm wondering if you can look more into the type of deposit, if you're looking at a very liquid deposit, or more stable deposit, or more in general, or further. You may want to look at the difference between banks in available to access the public credit line from the central banks or something like that. I'm trying to figure out how usually what I would consider as to show up as a liquidity problem kind of seems to show up in the solvency problem. So sorry for a confusing question. But.
No. I completely. I think I understand. I think you are more worried about that. We are not really capturing exactly what could be a cross-sectional differences between liquidity risks that banks actually face, right? So which banks actually have better access to Federal Reserve credit lines and so on, to tease out more whether there might be. So we are kind of going over that and say, okay, look, liquidity risk doesn't play a role, it's really just capital, and you want us to be a bit more sort of to dig a little bit more deeper into that. The short version is we haven't done that yet. I could probably look a bit more, and so kind of as you're fully right, I'm currently aggregating basically everything in terms of outstanding credit lines. So we could look a bit more into that. And also more on the liquidity side. So what we do right now is, and I think I might be a bit short about that, is that we look at the deposit side. Maybe that's even, I think that's maybe even a bit easier for us to see. I think I've shown you this aggregate figure, and that basically shows that much more deposits have been actually put into the banks in aggregate compared to the credit line drawdown. Say, okay, apparently on aggregate, that's not an issue. But of course, there could be distributional differences that some depositors have not really trusted some banks that much. So they deposited more in some than in others. And that would be a more clearer measure of some banks having more liquidity issues than other banks. So we could probably exploit that a bit more as well. Right. Thank you.
Thank you. May I just follow up on that one? I'm thinking from a policy perspective. I mean, there exists the drawdown risk, and there exists the possibility that the banks are not receiving the increase in deposit during this unusual time. But the question is, to what extent is there any policy policy mistakes, policy bias? Are you making any? Can you make any comment on? Can you make some comment on to what extent can we use your result to infer whether there is any need to change the policy and the regulations? And I also worry about when we are pushing all banks to be overly cautious, then there would be systematic reduction in risk taking.
I understand. So I think the regulatory implication, and I think I'm drawing here my conjecture from comparing what we find like 10 years during the global financial crisis compared to the pandemic, is that regulators have reacted correctly, likely correctly, to the risks that have materialized during the global financial crisis. And that was more coming from a wholesale funding, from a short-term funding problem that banks had. And if you compare, for example, Viral has a nice paper with Nada Moha and the JF, in which they talk more about the deposits. There you can actually see that banks were actually not able to fulfill their mandate as liquidity providers to provide these credit lines to firms until there has been a substantial fiscal support of banks. So there has been a liquidity risk at this point, and that has been addressed with liquidity regulation and so on. And banks have substantially reduced also their reliance on wholesale funding. But the problems of the potential capital problems that come along with that, and particularly with the commitment of credit line, that has not been addressed. And I think that this is something that we try to point to, and the stress test that we do towards the end is one way to actually do that. Okay, if we were to include that in the stress test, what would be a capital requirement that banks could actually should be imposed on? But I think other research also during the last couple of months has shown that this drawdown issue has also kind of distributional consequences of across firms, right? So there's some work on like a size, a firm size consequences across for firms, saying that, okay, there seems to be some sort of spillover effects into firms, right? Some large firms draw down credit lines, and banks' balance sheet capacity becomes used. So they need to cut somewhere. They actually cutting credit lines for small firms, and they're actually not able to actually provide more credit to the overall economy. So there's these spillover effects we have to consider, right? So that seems to be there is a role for regulation in terms of addressing that in an aggregate in an aggregate risk that we might face. And just to make my last point, I think then probably run out of time also. I think even though now in the situation with the vaccination and also the developments in the last in the last months, currently that's not the effect of liquidity risk on stock returns. We do not see because it does not materialize right now. But I think that this problem might potentially be even bigger now, right? Because credit lines have been repaid, so this ex-ante risk is again there. We have actually even more credit lines in the system, so it's even bigger. And the firms have repaid the credit lines not basically by reducing cash, but by taking out more debt, right? So there's actually a more leveraged corporate sector and an even higher exposure of firms to these aggregate drawdown risk. So if such a situation like that we observed at the beginning of March last year were to materialize again, the implication on the banking sector would be even bigger than what we have seen last year. So we really need there is a need.
So let's move on to the next paper. Otherwise, I see we're already a couple of minutes behind our timing. Thank you for that.
Thank you so much.
And for the questions.